to maximize your chances of getting pre-approved for a mortgage, it's a good idea to know which factors and metrics lenders use to look at in your financial profile. They will look at your DTI ratio. For a more detailed explanation on this DTI ratio, look for the link in the description. They will look at your LTV ratio, which I will offer a detailed explanation here in this video. They will look at your credit history, your FICO score, your income, and lastly, your employment history. For those of you who are looking to make a purchase on a home, or on your first home or your second home, you should watch the video tips for home buyers I make separately. You can find a link in the description. So another metric that lenders use to evaluate you for a mortgage is the LTV ratio. So what is an LTV ratio? An LTV ratio means loan to value ratio, which is calculated by dividing the amount of loan that you're trying to borrow by the value of the home. The home's value is determined by the property's appraisal, which might be higher or lower than the seller's asking price. For example, when you make an offer on the property of interest, the lender will send out an appraiser to come out to get an appraisal on the property and determine a value for it. This value of the property will then be used for the loan to value ratio. The loan to value ratio, or LTV ratio formula, is where your down payment comes into play. A down payment is the upfront sum of money that you pay to the seller in cash at the closing table. The higher your down payment, the lower the loan amount would be, and as a result, the lower your LTV ratio. So for example, you're looking to purchase a property, and the property's appraisal value is at $1 million. And you're looking to put down a down payment of $200,000. That's 20% of the appraisal value. Therefore, your loan amount would be $800,000. So to calculate your loan to value ratio, you would take $800,000 divided by $1 million. That would give you 0.80. And if you want to get a percentage, multiply by 100, you would get 80% loan to value of the house. If your loan to value ratio is larger than 80%, you might need to pay for PMI, which is private mortgage insurance. This insurance protects the lender if you fail to repay your mortgage. Having to pay for a PMI will raise the cost of borrowing the loan. To lower your loan to value ratio, you either need to put down more money or buy a less expensive house. Lenders will also look at your income and employment history. Essentially, lenders want to ensure that you can handle the added financial burden of a new mortgage. Have a great day. I hope you enjoy my video, and we'll see you in the next video.